Your retirement account is funding a debt crisis that could destroy everything you've saved, and you probably don't even know it's happening. As of January 2026, the United States government owes $38.4 trillion. That number climbed by $8 billion every single day last year. Every American now carries $112,000 of this burden on their shoulders, whether they realize it or not. Here's what almost nobody understands. When you check your 401k balance or look at your money market account and feel secure because those numbers are growing, you're not seeing the full picture. Those savings aren't sitting safely in a vault somewhere. A massive portion of your retirement money has been quietly loaned to the federal government, and that government is now spending more on interest payments than on national defense. The system works because it's invisible. You think you're investing in safe, stable assets. Target date funds, bond portfolios, money market accounts marketed as cash equivalents. What you're actually doing is lending your future retirement income to a borrower that's adding debt faster than it can ever realistically pay back. And the mathematics behind this arrangement just broke. Let me show you exactly how your money flows into government debt without your permission or awareness. When you contribute to your 401k, your employer likely defaults you into a target date fund. These funds automatically shift your allocation from stocks to bonds as you approach retirement. The rule of 100 says, subtract your age from 100 to get your bond percentage. A 55-year-old should hold 45% bonds. A 65-year-old should hold 35%. Financial advisors treat this as gospel. Those bond allocations, they're overwhelmingly Treasury securities, government debt. If you have $500,000 saved at age 55, you could easily have $200,000 in Treasury bonds through your retirement account. You didn't choose this exposure. It happened automatically because the financial industry considers government debt the safest investment on earth. Now let's talk about money market funds, because this is where millions of Americans get blindsided. You probably keep emergency savings in a money market account. It feels identical to a savings account. Same liquidity, same stability, same sense of security. But government money market funds invest almost exclusively in short-term Treasury securities. That $50,000 you're holding for emergencies, you've effectively handed it to the federal government as a loan. Banks do the same thing with your deposits. When you put money in a savings account, the bank doesn't just lock it in a vault. They invest those deposits, and a significant portion goes into Treasury securities because regulations require banks to hold safe, liquid assets. Your everyday checking and savings accounts are feeding capital into government debt. Pension funds represent the most troubling example because you have zero control over these decisions. Public pension systems hold massive allocations of Treasury bonds. Teachers, firefighters, police officers, government workers, they're all depending on pension promises backed substantially by loans to a government drowning in debt. Unfunded pension liabilities already exceed $5 trillion, with overall funding ratios below 50% for many systems. The total domestic ownership of Treasury securities tells the story. $20 trillion held by American institutions and households. The Federal Reserve holds $3.8 trillion. Institutions hold $8.4 trillion. Households directly hold $2.7 trillion. Add it all together and you realize the entire American financial system is built on lending money to the federal government. Foreign holders own another $9.1 trillion, with Japan holding $1.1 trillion, China holding $800 billion, and the United Kingdom holding $700 billion. But it's the domestic exposure that should worry you most, because that's your retirement, your pension, your emergency fund. Interest payments crossed $1 trillion annually for the first time in history. Let that sink in. $1 trillion every year just to service existing debt, not to pay anything down, just to cover interest. That's now the second largest expenditure in the federal budget, bigger than Medicare, bigger than defense spending. 6 years ago, in 2020, interest payments were $345 billion. They've tripled. The Congressional Budget Office projects interest costs will consume $13.8 trillion over the next decade, rising from $1 trillion in 2026 to $1.8 trillion by 2035. That's assuming interest rates don't spike further, which is an optimistic assumption at best. Here's what changed recently that makes this crisis immediate rather than theoretical. The average interest rate on total marketable debt hit 3.36% in December 2025. That's up from 1.55% just 5 years ago. The debt load is so enormous that even modest rate increases create catastrophic budget pressure. This is where the math becomes inescapable. When Paul Volcker raised rates to crush inflation in the early 1980s, national debt was only 25% of GDP. The government had time to adjust because interest costs grew slowly. Today, debt sits at 120% of GDP. Rate increases hit the budget instantly. The Federal Reserve's traditional inflation-fighting tools now backfire because higher rates inject more money into the economy through interest payments to bondholders. Economists call this fiscal dominance. The debt becomes so large that monetary policy gets subordinated to the government's financing needs. The central bank can't raise rates enough to control inflation without making the debt completely unserviceable. We're approaching that threshold right now, and your retirement savings are caught directly in the crossfire. But the real danger isn't just the size of the debt or the interest payments consuming the budget. The crisis accelerates because of what happens when this system reaches its breaking point. The breaking point arrives through what economists politely call a debt spiral, but what you should understand as financial quicksand. Every step the government takes to escape makes the situation worse. The mechanics are brutally simple. When debt reaches critical mass and interest payments consume this much of the budget, the government faces an impossible choice. They can cut spending dramatically, raise taxes substantially, or borrow even more to cover the gap. Cutting spending means slashing Social Security, Medicare, defense, everything Americans depend on. Raising taxes enough to matter would require increases so severe they'd crater economic growth, which reduces tax revenue, which makes the problem worse, so they borrow more. But borrowing more increases the debt, which increases interest payments, which requires more borrowing. The spiral accelerates, and your savings are the fuel feeding this fire. Think about what happens when the government needs to roll over maturing debt. They're not just paying interest on existing obligations. Trillions in Treasury bonds mature every single year and must be refinanced with new bonds at current interest rates. In 2020, when rates were near zero, rolling over debt was cheap. Today, with rates above 3% and climbing, refinancing costs explode. A 10-year Treasury bond issued in 2015 at 2% is maturing now and getting replaced with a new bond at 4.8%. The interest cost just more than doubled on that portion of debt. Multiply that across trillions in maturing securities, and you see why interest expenses tripled in 6 years. Your 401k is directly exposed to this refinancing crisis. Target date funds automatically increase bond allocations as you approach retirement. The typical 55-year-old has 40 to 50% of retirement savings in bonds. If you've saved $500,000, you're holding between $200,000 and $250,000 in bonds, much of it Treasury securities. You've essentially loaned $250,000 to a government that's mathematically incapable of paying it back at full value. Financial advisors sold this as the safe conservative approach. The rule of 100. Subtract your age from 100 to get your stock allocation. Put the rest in bonds. A 60-year-old should be 40% bonds. But that rule was written for a world where government debt was manageable and bonds actually provided safety. Money market funds reveal an even more insidious exposure because people treat them like cash. Families park emergency funds in money market accounts, thinking they're as safe as checking accounts. What they don't realize is government money market funds invest almost exclusively in short-term Treasury securities. That $50,000 emergency fund you're keeping for job loss or medical crisis, you've lent it to the federal government. The fund manager takes your cash, buys Treasury bills, and passes the interest back to you minus fees. You see a stable account balance and assume everything's fine. But you're not holding cash. You're holding a claim on government debt that could lose value rapidly if Treasury markets destabilize. Pension funds create the most dangerous exposure because you have zero control. Public pension systems managing retirement security for teachers, firefighters, police officers, government workers hold massive Treasury allocations. These funds face a brutal calculation. They've promised specific retirement benefits to millions of workers. To guarantee those payments, conventional wisdom says invest in the safest assets available. US Treasury bonds used to fit that definition perfectly. But safety is relative. Treasury bonds are only safe if the government can service its debt. When debt hits 120% of GDP and interest costs are cannibalizing the budget, that's no longer a safe assumption. Yet pension funds can't easily pivot because they're constrained by regulations requiring investment-grade securities and fiduciary duties demanding conservative allocations. The scale of pension fund exposure is staggering. Unfunded pension liabilities already exceed $5 trillion. The gap between promised benefits and available assets sits below 50% for many systems. These funds are underwater even before accounting for potential Treasury market disruptions. A retired teacher receiving $40,000 annually from a state pension might not realize the fund backing those payments is heavily invested in government debt. If Treasury values decline, pension funding ratios collapse further, and those retirement promises become increasingly difficult to keep. Here's where the math becomes truly frightening. The crowd-out effect means productive capital gets diverted to government consumption instead of private sector investment. When banks, insurance companies, pension funds, and individual investors pour trillions into Treasury securities, that money can't fund business expansion, innovation, infrastructure, or job creation. The government absorbs available capital to pay current bills rather than investing in future growth. This isn't theoretical. Real-world impact shows up in reduced business lending, lower productivity growth, and diminished economic dynamism. Foreign ownership compounds the problem. $9.1 trillion in US debt sits in foreign hands. Japan holds $1.1 trillion. China holds $800 billion. The United Kingdom holds $700 billion. Every dollar in interest payments flowing to foreign bondholders is wealth leaving the American economy permanently. We're not just paying interest, we're transferring national income abroad to service debt incurred for past consumption. The trade deficit already sends dollars overseas for imported goods. Now interest payments create a second channel for wealth extraction. As debt grows, an increasing share of American economic output flows to foreign creditors rather than benefiting domestic workers and families. The crowd-out effect extends beyond capital allocation. Government borrowing pushes up interest rates across the entire economy through simple supply and demand. When Treasury issuance floods the market with new bonds, buyers demand higher yields to absorb the supply. Those higher Treasury yields set the baseline for all other interest rates. Corporate bonds, mortgages, auto loans, credit cards, everything prices off the risk-free Treasury rate plus a spread. So when Treasury yields spike, every form of borrowing becomes more expensive. Businesses delay expansion. Families can't afford homes. Consumer spending contracts. Economic growth slows, which reduces tax revenue, which increases deficits, which requires more borrowing. Another spiral, another trap, and your retirement savings caught in the middle, funding the entire catastrophe. The fiscal dominance trap represents the endgame scenario that keeps economists awake at night. When debt reaches 120% of GDP, the Federal Reserve loses its primary weapon against inflation. Raising interest rates to cool an overheating economy becomes impossible because higher rates would immediately blow up the federal budget through skyrocketing interest costs. Think about the mechanics. Every 1% increase in average borrowing costs adds $380 billion in annual interest expense. The Fed can't fight inflation without bankrupting the Treasury. This wasn't true in 1980, when Paul Volcker jacked rates to 20% to crush inflation. Back then, debt was only 25% of GDP. The government had time to adjust. Interest costs rose gradually. By 2026, the debt load is so massive that rate impacts hit instantly. Raising rates becomes counterproductive because it pumps money into the economy through higher interest payments to bondholders. The cure makes the disease worse. Janet Yellen warned about this exact scenario. Fiscal dominance forces the central bank to prioritize government financing over price stability. The Fed gets pressured to keep rates artificially low not because economic conditions warrant it, but because the government literally cannot afford higher borrowing costs. That's not monetary policy anymore. That's debt management masquerading as economic stewardship. Markets understand this dynamic. Bond investors know the Fed is trapped. They know inflation will eventually accelerate because the government needs to inflate away its debt burden. So they demand higher yields to compensate for expected inflation. This creates a vicious feedback loop. Higher yields increase borrowing costs. Higher costs force more debt issuance. More issuance requires even higher yields to attract buyers. The spiral accelerates until something breaks. Your savings sit right in the blast radius. Every dollar in your 401k bond allocation is a bet that this debt trajectory somehow stabilizes. Every dollar in money market funds is exposure to Treasury securities that could lose value if yields spike further or confidence cracks. The traditional safety of government bonds evaporates when the government itself becomes the systemic risk. Financial advisors built entire careers on the assumption that treasuries represent the risk-free rate. That assumption is dying. When government debt approaches 150% of GDP, when interest costs exceed defense spending, when foreign creditors start questioning sustainability, treasuries stop being risk-free. They become speculative bets on political willingness to implement pain-few or fiscal reforms. Nobody wants to say it explicitly, but the math leads to three possible outcomes. First option is massive spending cuts combined with tax increases. We're talking trillions in adjustments over decades. Social security benefits reduced, Medicare eligibility tightened, defense spending slashed, income taxes raised substantially. This is the responsible path. It's also political suicide. No Congress wants to be the one telling voters their retirement benefits are getting cut and their taxes are going up simultaneously. Second option is sustained high inflation. Let prices rise 7 to 10% annually for a decade. That inflates away the real value of the debt. A $38 trillion debt becomes manageable when the economy is twice as large in nominal terms. But inflation destroys savings, crushes fixed-income retirees, and creates social instability. It's a hidden default that punishes savers and rewards debtors. Third option is outright default, or restructuring. The government announces it cannot meet obligations as promised. Bondholders take haircuts. Social Security gets means tested. Medicare becomes a voucher program. This is the nuclear option that destroys America's credibility and reserve currency status. Each path involves tremendous pain. The only question is, who bears the cost? Spending cuts hurt current beneficiaries. Inflation hurts savers and retirees. Default hurts bondholders and destroys institutional credibility. Your retirement savings get hit regardless of which path politicians choose. Bond allocations lose value through inflation or default. Stock holdings suffer because economic growth collapses under the weight of austerity or inflation. Real estate faces pressure from demographic shifts and affordability crises. There's no safe corner to hide. Understanding your exposure is step one. Pull up your retirement accounts right now. Calculate what percentage sits in bond funds or treasury securities. If you're over 50 and following traditional advice, you likely have 30 to 50% in bonds. That's potentially hundreds of thousands of dollars tied to government debt sustainability. Money market funds holding emergency cash, that's direct treasury exposure. Bank savings accounts. Banks invest deposits in treasuries as part of their reserve requirements. You're exposed even when you think you're playing it safe. The system is designed to funnel your savings into government debt, whether you explicitly choose that or not. What can you actually do? Diversification becomes critical, but not traditional diversification. You need assets that perform differently under fiscal crisis scenarios. Hard assets like commodities, precious metals, and real estate provide inflation hedges. International exposure reduces concentration in US fiscal outcomes. Quality dividend-paying stocks from companies with pricing power can pass inflation costs to consumers. These aren't perfect solutions. Every asset class has risks. But concentration in US government debt through traditional bond allocations might be the biggest unrecognized risk in most portfolios. The assumption that treasuries equal safety is outdated and dangerous given current debt levels. The debt reaches $38.43 trillion and climbing $8 billion daily. Interest costs hit $1 trillion annually. Your retirement funds own trillions in treasury securities. The government faces impossible choices between spending cuts, inflation, or default. Every path leads through pain. The only question is whether you see it coming and position accordingly, or whether you maintain traditional allocations and hope politicians somehow solve a mathematical problem that gets worse every single day. Math doesn't care about hope. Debt compounds, interest accrues, bills come due. Your savings are funding the whole operation. The system already has you locked in. Traditional financial advice, target date funds, money market accounts marketed as safe havens, they've all funneled your wealth into government debt without requiring your explicit consent. The advisory industry built portfolios on the assumption that treasuries represent safety. That assumption breaks when the borrower becomes the systemic risk. You can't opt out completely. The exposure runs too deep through the financial system. But you can stop pretending bonds equal safety when debt hits 120% of GDP. You can recognize that emergency funds in money market accounts are loans to a government spending $8 billion more than it takes in every single day. You can understand that pension promises backed by treasury holdings face mathematical sustainability questions nobody wants to discuss publicly. The $38 trillion doesn't disappear. It compounds. Interest accrues at over $1 trillion annually now. Politicians face choices they'll delay as long as possible because every option involves pain. Spending cuts anger voters. Tax increases crush growth. Inflation destroys savings. Default ends credibility. They'll kick the can until markets force a decision. By then, the adjustment becomes far more violent than if addressed earlier. Your retirement security depends on recognizing this reality before crisis forces recognition on everyone simultaneously. The math guarantees pressure builds. The only uncertainty is timing and which breaking point arrives first. Prepare accordingly or watch decades of savings evaporate funding a debt spiral that was always mathematically inevitable.